Welcome to vTalkInsight, Market Drivers Daily for January 15th, 2026. Geopolitics, a powerful growth upswing, and an AI-driven capital cycle are colliding in markets, with risk premiums now shifting across commodities, equities, and credit. Geopolitical risk is still the dominant macro driver, but the transmission has shifted toward commodities and select equity sectors rather than broad-based risk aversion. Compared with earlier this week, when safe haven demand was concentrated in gold and the US dollar, we now see oil, base metals, and defense stocks absorbing more of the geopolitical premium. At the same time, headline volatility gauges like the VIX remain subdued even as longer-dated volatility expectations drift higher, signaling that investors see a fatter tail risk distribution without yet de-risking core positions. The Middle East remains the most immediate flashpoint, with unrest and a violent crackdown in Iran raising the risk that as much as 1.4 million barrels per day of crude could eventually be at stake. Oil has just logged its largest four-day rally in more than 6 months, and some forecasts see Brent gravitating towards $70 and WTI toward the high 60s as geopolitical risk premia build. Yet the move is not one way. Comments hinting at possible de-escalation in Iran have already knocked crude lower, and analysts point out that current price levels still reflect risk premium rather than confirmed supply loss against a backdrop of reported oversupply from the U.S. and Canada. Safe haven flows have spilled decisively into metals. Gold, silver, copper, and tin are at or near record highs, with gold now above $4,600 an ounce, and some targets stretching toward $5,000 as investors hedge against geopolitical shocks, inflation risk, and concerns about central bank independence. Precious metals miners such as Barrick and Newmont are rallying in pre-market trading. While both precious and industrial metals attract capital for different reasons, safe haven demand on one side, and optimism about Chinese exports, AI-related demand, and a potential new commodity supercycle on the other. Geopolitics is also tightening its grip through trade and resource policy. Markets are focused on a potential U.S. Supreme Court ruling on global tariffs, with some estimates putting the odds of a broad strike down near 60%, even as the administration retains other tools, such as sector-specific tariffs on autos, steel, and aluminum, to keep pressure on trading partners. China has banned certain U.S. and Israeli cybersecurity software. U.S. export controls on NVIDIA's AI chips to China have been partially eased, but remain capped and subject to case-by-case review, and both Washington and Beijing are racing to lock in supplies of critical metals and rare earths. Those dynamics are particularly visible in Greenland and the wider Arctic, where Denmark and Greenland are reinforcing NATO ties. France is opening a consulate, and debates over U.S. ambitions and underinvestment in local security highlight how sovereignty and resource access are becoming intertwined risk factors. Defense and security assets are another clear expression of this regime. European defense companies have outperformed sharply, with share prices up about 17% year-to-date and around 100% over the past year, and ammunition producer CSG is preparing a large Amsterdam IPO that could raise from the high hundreds of millions to several billion euros. A major European defense group is pursuing aggressive mergers and acquisitions to become the region's largest player, while the World Economic Forum's latest risk report flags geoeconomic confrontation as a top global risk, and regulators stress tight oversight of prediction markets on war and terrorism. Yet despite oil and defense re-rating, G10 rates and foreign exchange have reacted only modestly, leaving much of the adjustment in commodities, sector equities, and longer horizon volatility rather than in broad risk-off behavior. For now, the key watch points are any credible threat to Iranian supply, the path of oil and metals after this rally, Supreme Court action on tariffs, and the timing of upcoming European defense listings, all of which will feed back into how sustainable the current growth upswing looks. The growth backdrop remains surprisingly strong, but the character of this expansion is shifting toward investment and productivity rather than classic job-driven demand. Building on the productivity narrative we have discussed in recent days, Recent U.S. GDP prints have consistently beaten expectations, and forecasts for this year now cluster above 3%, powered by capital spending, technology, and a substantial fiscal impulse. This matters because it supports earnings and credit metrics even as the labor market shows signs of cooling, reinforcing a soft landing rather than a hard downer in the near term. On the data front, U.S. GDP growth is projected around 2.8% for 2026, with momentum near 3% through the first three quarters before moderating toward the low twos by year-end, especially if political gridlock emerges. New U.S. legislation is expected to deliver a meaningful fiscal boost as early as February, and November retail sales rose 0.6% month-on-month, outpacing forecasts, while headline and core measures both showed solid gains. Wage growth has outstripped inflation, supporting real incomes, yet incremental growth this year is expected to come less from the consumer and more from corporate investment, tax incentives such as accelerated depreciation, and wealth effect from stronger asset markets. Beneath the surface, the composition of growth is changing. Output gains are increasingly driven by investment and total factor productivity rather than incremental hiring, leading some to describe the current phase as a jobless expansion. Productivity improvements are now running ahead of GDP growth, helped by spending on AI and non-AI equipment. Large capex programs from automakers like Ford and General Motors, and heavy investment in data centers, power infrastructure, and industrial capacity. At the same time, investors are adding commodities and other real assets as diversifiers even in a disinflationary environment, reflecting confidence in global growth reacceleration and the possibility that today's metals rally could mark the early innings of a new commodity cycle. Corporate earnings and sector patterns largely reinforce this constructive macro picture. U.S. banks are reporting better than expected numbers. Bank of America delivered 7% revenue growth with double-digit gains in net interest income, wealth management, and trading, while management expressed confidence in the U.S. consumer and in the 2026 outlook. Large banks more broadly are poised to benefit from solid GDP growth, improved loan demand, strong capital positions, and some regulatory relief, with loan growth accelerating from near zero to around 5 to 6% year-on-year, and Wells Fargo now free of its asset cap and expanding in investment banking. Outside of financials, Delta is projecting 20% earnings per share growth by 2026, supported by record demand in premium international travel. Asian equities are rallying with the Nikkei showing notable strength, and companies like Linda, Ulta, and SLB are positioned around themes such as healthcare demand, industrial production, and global energy and infrastructure spending. The main challenge is that this expansion is uneven. The U.S. economy is seeing a clear divergence between winners and losers, with labor share of income falling even as corporate margins hold up, and mid-sized firms and some small caps at risk of lagging larger, more capital-intensive players. There are also questions about how much of current consumption is wealth-driven rather than income-led, and whether markets are underestimating the risk that expected global reflation fails to show up in hard data during the first half of the year. On the policy side, stronger growth and robust retail sales may complicate the case for near-term Federal Reserve rate cuts, while potential Supreme Court action on tariffs could deliver an initial growth-friendly boost to equities but raise deficit concerns as tariff revenues decline. For now, investors are watching upcoming activity data, loan growth trends, and corporate guidance from banks, travel, and industrial names to judge how durable this investment-led cycle is and how much of it ultimately depends on the AI capex wave. Artificial intelligence remains the pivotal swing factor tying together both the growth and market stories. Economist estimates suggest AI and related technologies could add up to 200 basis points to global potential growth over time, more than offsetting some of the drag from tariffs and geopolitical fragmentation. At the same time, this is an increasingly complex investment theme, with heavy concentration in a few hyperscalers and private leaders, rising credit risk in parts of the supply chain, and growing political scrutiny around governance, labor markets, and inequality. The scale of the AI infrastructure build-out is striking. OpenAI's $10 billion chip deal with Cerebras, including commitments for up to 750 megawatts of computing power over 3 years, underscores the intensity of the race to secure advanced processing capacity. U.S. export restrictions on NVIDIA's AI chips to China have been eased, but remain capped at half of U.S. production and subject to case-by-case approval, while tin prices swing sharply on a mix of illiquidity, unresolved supply issues in Indonesia, and surging AI-related demand. Silver is benefiting both from its role as a safe haven and from its industrial use in AI and electronics, linking the AI theme directly back into metals markets and the broader commodity complex. On the corporate side, AI is beginning to deliver tangible, if still uneven, productivity gains. Some leading AI firms, such as Anthropic, are reportedly growing revenues at extraordinary rates, with estimates of as much as 500% growth every 6 months. And late-stage AI companies are attracting substantial capital from sovereign wealth funds, mutual funds, and retail investors. In the real economy, Airbnb has cut English-language customer service contact by about 15% through AI-driven automation, while keeping headcount broadly stable as AI-enabled growth offsets efficiency gains. And EssilorLuxottica plans with Meta to double production of AI-powered smart glasses to meet strong demand. Financial advisors are also deploying AI tools to boost productivity and deliver more personalized portfolios, while analysts expect AI adoption to enhance operating leverage in value-oriented sectors, such as industrials and healthcare, not just in the obvious technology names. However, this opportunity set comes with meaningful risks. Equity resilience is currently underpinned by the AI hyperscaler investment narrative, but concerns are growing that if only a handful of firms ultimately monetize these massive capital outlays, others could face solvency or refinancing pressures. Oracle is a case in point, with aggressive borrowing to fund AI infrastructure pushing its debt load toward the lower end of investment grade and creating an overhang for both equity and bondholders. Public market sentiment has also shifted. Recent AI product launches for major tech platforms have sparked sharp drawdowns in established software names, such as Adobe and Salesforce, even though AI has not yet materially damaged their fundamentals, and investors are increasingly rotating away from concentrated megacap AI exposure towards small caps, value, and equal-weighted strategies in anticipation of a broader 2026 rally. All of this is playing out against a backdrop of eroded public trust in technology after past controversies and rising concern that without stronger governance, AI could deepen K-shaped outcomes in labor markets and income distribution. Looking ahead, the center of gravity for AI-related opportunities may gradually shift. Analysts expect future value creation to move from today's infrastructure providers toward application and intelligence layers, and perhaps even more toward traditional sectors, such as life sciences and materials, where AI could enable breakthroughs that matter more for the real economy than for headline AI equity indices. Portfolio construction discussions already reflect this, with more emphasis on diversification across real assets like real estate and infrastructure, alongside selective bond and equity exposures, as a way to mitigate concentrated AI risk. Key watch points now include hyperscaler capex guidance and funding plans, regulatory debates on AI governance and export controls, OpenAI's next fundraising round, and evidence that AI-driven productivity gains are starting to reach mid-sized firms rather than remaining confined to large enterprises and nimble startups. How these questions are resolved will go a long way toward determining whether AI ultimately amplifies the current growth acceleration or instead becomes a new source of volatility in both credit and equities. To sum up, geopolitical risk is being priced most visibly through oil, metals, and defense, while rates and currencies stay relatively calm. The growth backdrop remains robust and increasingly investment-led, with banks, travel, and industrials signaling confidence, even as the expansion looks more K-shaped and jobless. AI ties these stories together as both the engine of future productivity and a potential fault line for valuation, credit, and policy risk, making the balance between exposure and diversification a central question for multi-asset portfolios. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.